Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 25th of July 2021. And when we hear so many people talking about stock market bubbles and imminent stock market crashes, even though all three US indices reached all-time records last week, out comes an article from Bloomberg telling us that there are literally trillions of dollars still waiting to enter the equity markets as soon as prices begin to dip. Now this is a story we have to take a look at. Well, this was published by Bloomberg yesterday. Headline: Stocks bulls look towards $17 trillion, burning a hole in pockets. Really? Let's just see what this Claire Ballantyne has to say. In the stock market, the refusal of retail investors to back down from every macro threat has become the only story. When will it end? Judging by the size of all the pools of cash lying around, it could be a while. Among all the economic stories of the pandemic, the one about money piling up in people's accounts has been the most significant in the stock market, where the S&P 500 just notched its seventh gain in 9 weeks. Money market accounts, viewed in some circles as dry powder, reserved for equity deployment, sit at just under $4.5 trillion. So in other words, there is sitting lying around, not invested as yet, just under $4.5 trillion. A more obscure balance, the Federal Reserve's count of money on deposit with commercial banks, has risen 33% from 2019 to $17 trillion. Now, this is what the insiders know. While none of the money is completely unencumbered, and professionals tend to hate the concept of cash on the sidelines, something is arming the day traders cadres who seem bent on letting no market sell-off last more than 24 hours. Which we saw last week, of course. We saw the stock market fall dramatically 2% last Monday, which she now talks about, so I'm talking ahead of reading the article. Take Monday, for example, when fears the Delta variant would upend progress sent the S&P 500 down as much as 2.2%. Dip buyers ran to the rescue then and the rest of the week, sending the S&P 500 higher by almost 2% through Friday, despite virus cases still spiking. We have investors who are eager to deploy cash, said Sarah Rajo-Miller, investment advisor at Miracle Mile Advisors. People sometimes forget how much power retail investors can have over the market, and we've seen that play out clearly. That momentum can really push stocks higher. So how powerful is the retail cannon? Well, on Monday alone, they bought a record $2.2 billion worth of equities, with the biggest exchange-traded fund tracking the S&P 500, ticker SPY, alone notching an all-time high of $482 million in retail purchases, according to Vanda Research. So there's no shortage not only of cash, but of retail investors willing to put that cash potentially at risk. An analysis from DataTrack Research showed that Google searches in the US that day for the phrase Dow Jones, the term most associated with stock market investing, according to the firm, spiked when stocks declined quickly, peaking at 1 p.m. in New York. It's almost like investors are seasoned to say, stocks are down, it's got to be a buying opportunity, said Gene Goldman, Chief Investment Officer at Cetera Financial Group. Part of that is because there's no other game in town right now. You look at bond yields so low, cryptocurrencies struggling, other parts of the market are not that great. And this is true. And listeners to this podcast will, if you have time, nip over to the Crypto Plus channel, our sister channel, where we look at Nicki's portfolio today. Now, whether it'll be published at the same time as this one, or probably slightly after. But do go and have a look, because you'll see that Nicki, who has been investing for a month now, a novice investor, doesn't quite understand all the intricacies, and was down as much as $3,500 at one stage during the course of this past week. However, her portfolio has vastly improved since then, which shows the volatility in cryptocurrencies. Such volatility that for the speculator, it's a wonderful environment. For those whom perhaps are a little more conservative, it frightens them off. The unending appetite for stocks led equity ETFs to break their annual record in April, and the pace hasn't slowed since. In July, the products have already taken in more than $15 billion, helping fuel total ETF inflows to the brink of a full-year record, with more than 5 months to go. So what about this stock market crash all the pumpers were telling us was happening after that Monday fall? Certainly hasn't happened yet. Will there be a correction? Of course there will be. However, an imminent crash? Just like the imminent demise of the dollar that some have been talking about for 20 years. No end in sight. Equity ETFs have already taken in more cash in 2021 than any year before. Still, other measures of retail prowess show a mixed picture. And this is where we start to get into reality, and which is why we highlight articles such as this. Data from Charles Schwab shows that the percentage of cash in their clients' brokerage accounts in June fell to 10.5%, the lowest since 2018. That probably suggests that the dry powder has been put to work over the course of the year, but maybe it's not entirely out of fuel for further investment, said Jeffrey Kleintop, Chief Global Investment Strategist for Charles Schwab & Co. There's still a good bit of momentum and desire to put money to work and look for alternatives to the bond market, which remains relatively unattractive. Retail money fund balances still have $1 trillion versus $643 billion in 2015, according to DataTrack, with analysts calculating that there's $400 billion in buy-the-dip cash ready for the next drawdown. Plus, retail favourite Robinhood has 13 million more funded accounts than it did before the pandemic. The buy-the-dip mentality is the one the Fed has taught institutional and retail investors to follow. And the Fed remains hyper-easy, said Jim Schmiegel, Chief Investment Officer of SEI. The biggest positive out there is that the easy stance from the Fed is in place, and every other central bank, and is going to be in place for quite some time. So there we have it. Plenty of money still potentially ready to chase stocks. We had all three indices in the US hit all-time high last week. And this is part of the reason. Isn't it ironic when the future recovery of the global economy is perhaps not so much in question, but there are signs it's not going to be quite as quick and speedy as many had forecast, and yet more and more money is going into the equity markets. Yes, this is ultimately creating an asset bubble that one day will either burst or perhaps just deflate. But that said, it can still have further to pump. So all the doomongers telling us that this is the end any day now, yes, theoretically, that can be the case. But if you actually look at the underlying fundamentals in terms of cash availability, and we all know, unless something quite disturbing happens on the FOMC meeting on Wednesday and declaration, we all know this easy money is going to continue for some time to come. And whilst Austrian economists will say, and those who follow Austrian economics will say, this is devastating for the currency. Yes, it is, but what they seem to miss is everyone's doing it. And so it's down then to an issue of parity. Will the chickens come home to roost eventually? Yes. But do not be fooled into thinking it's going to be tomorrow. We suspect it most certainly isn't. There's still some elasticity left in this equity market rubber band. Thank you so much for listening. Please give us a thumbs up, share, subscribe, press the bell sign, and let us know what you think. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.